David Cunliffe.
Mr Chairman, thank you for the opportunity and thank my colleague for his insights there. I wish to dig down into the drafting of section 43B(1). A trustee of a trust is not required to furnish a return of income for the trust in the tax year if throughout the tax year the trust is a non-active trust and it's a complying trust, and in B, a trustee of a trust has made and furnished to the Commissioner in a form approved by the Commissioner a declaration that it's a non-active trust and that he will notify, or she will notify the Commissioner if it stops being a non-active trust, and a statement on other matters that the Commissioner may from time to time require. The issues here, sir, are quite interesting. The fact that the trustees need to seek permission in advance from the Commissioner rather diminishes the purported saving in overhead that the supposed simplification was seeking to achieve. In other words, it's no less work for the accountant to write to the Commissioner with a declaration that the trust is a non-active complying trust than it is to write and say that it's a nil return. So I guess we question whether the construction of 43B(1) assists to achieve the stated aim of the section, which is to reduce a compliance burden. Sir, in clause 2, the plot, as they say, thickens because there are a number of criteria which need to be met apparently simultaneously for a trust to be deemed to be a non-active trust. In clause 2, for the purposes of this section, a trust is a non-active trust for a tax year if throughout the tax year, so that's the first point, it must be true throughout the whole of the tax year and any exception to that must be notified, again implying probably more compliance than would have been required if it simply filed a nil return, and A, has not derived or been deemed to have derived any income. So there are two parts to that subclause 2A. Derived or deemed to have derived. Derived means they've produced income and they have self-declared it. Deemed means that it has been inferred, I would imagine, I ask the Minister to clarify if I'm wrong, that some other party has inferred or deemed them to have had income. So there's a grey area there about what the deeming process is, who is able to deem, whether they can deem for themselves, whether any third parties can deem them, and that's probably something akin to deeming with faint praise, sir. The definition of income is not specified in the clause, which is, the first thing one would think would need to be done. Presumably income is defined elsewhere in the Act, but sir, there's a very special importance of the word income here because the whole bright line test turns on the benefit of capital gain being defined as income if that accrues to a property that is not a farm, not a business, has been sold within 2 years and is not lived in by the owner, or in the event that the owner has more than one property, their wairua or their vibe or their feeling is that it is not the one to which they're the most attached. And so you can see the hornet's nest of subjectivity that is opened up through that word income, especially in clause 2A, if the deeming provisions allow that subjective interpretation to be inferred by a third party. So I think that third party issue is something the Minister really needs to address. In 2B, and this is an and provision, it must also have no deductions. Now, in the first pass again, deductions are not defined in this clause. The clause is reliant upon general definition and case law of the word deduction, but it does impinge on the definition of costs, because any costs of sale or costs of the land which is being disposed of and thus taxed could be construed as a deduction. Now, the tax test elsewhere, sir, is a net test, Mr. Chairman, a net test. in the sense that the costs, for example, of real estate fees, of interest, of any other, painting the house before it's sold, you name it, rehousing the family pets, is all a cost against the sale, and they can be deducted from the sale price in order to reach the net taxable amount. Yet here in 2B, there is a has no deductions clause, and I think that's confusing. The fact that something is a trust rather than a natural person or a different form of legal entity should not obviously determine the definition of deduction. And so it would be very helpful for the Minister to take a call and specify to the House whether the definition of deduction here is the same as the definition in those other parts. In 2C, has not disposed of or been deemed to, there's that word deemed again, disposed of any assets of the trust. So we're talking trust assets here, and the law here is requiring the trustees to certify that there's been no disposals. That should be self-evident, but again, there's case law around the definition of disposal. And D, subclause 2D, the trust has not been a party to or perpetuated, there's a lovely word, or continued with any transactions with assets of the trust during the tax year that give rise to income in any person's hands or give rise to fringe benefits to any employer or employee. Now, I am just literally giving a plain English reading of the sub-clauses of that operative clause, the most important operative clause in this part, partly because it's almost the only clause in this part. And what is clear already, Mr. Chairman, from this cursory romp through the jurisprudence of this one clause is it would have been a bally sight easier for the poor old trustee to do an email to the Commissioner saying nil income than wade through this veritable thicket of definitional quagmire, to mix a metaphor. This ain't simple. There are any number of deemings that could trip a trustee, and often trustees are working pro bono, especially in family trusts. I know that there's been a great stack up of liabilities for trustees of late in trust law, and that is discouraging, sir, people from taking on trustee roles, particularly family trustees. Let's turn now to subclause 3, so we're talking 43B3. Subclause A, in determining whether a trust complies with the requirements of subsection 2, the one we previously exegeted, we turn to A, reasonable fees paid to professional trustees to administer the trust, which goes to the point I've just made. Sometimes trustees are in fact pro bono, friends, family who administer a family trust for others. Subclause B, bank charges or other minimal administration costs totalling not more than $50 in the tax year. When are we going to get over the habit of writing numbers like $50 in legislation? 10 years from now, $50 will only be worth $40, or the current rate of inflation of the current government, probably $35. Is the government going to put this bill through the House to adjust for inflation? Why on earth have they put a manual amount as trivial as $50 in the legislation? Sir, surely that is further evidence that this has been rushed through the Select Committee in an inappropriate manner, and that kink wasn't ironed out at source. And it does go to the point, sir, that this whole bill is a sham. As we said in part 1, if you were really wanting to do something about the Auckland property bubble, you wouldn't do a 2-year bright line test that people can avoid by doing it in 2 years and 1 day, with more exceptions than I've had hot dinners. Sir, subclause 3C. Interest earned on trust assets in any bank account during the trust year to the extent to which the total interest does not exceed the total of any costs or charges incurred by the trust to which paragraph B applies. I don't know about you, sir, but I've got a headache reading through this subclause, putting myself in the shoes of Joe Average, who takes on a role for a friend of being a trustee of their family trust, because they are given the ability to state that they have no income and so they shouldn't have to file a tax return. But the mere process of making that statement is so much more complex than filing the tax return as a nil would have been in the first place. So why are we here? Why are we here making complexity when there was no need for any, Mr. Speaker? And the answer is because the bill was a sham.